All right, let's go ahead and get started. I said this is a 10 a.m. Webinar, not 10:05. So let's go ahead and get started. Thank you in advance for those who will watch the recording of this eventually. And thank you for those of you who have joined live. Really appreciate that. Hope you get a few nuggets out of this as we navigate through this in the next few minutes. I'm going to start with a story that really leads into why we're doing this. So I'm old. I've been doing what I do for a long time, well over 30 years. And over 20 years ago, I had this entrepreneurial flair. I was in public accounting at the time. I was an auditor, had been doing that for a while, 12, 13 years, and thought, well, maybe I could step out on my own and do my own thing and pursue some non-accounting interests, some business interests. What do I want to do? And I had some ideas, and there were a few of them, but one of them that I really wanted to do was I wanted to start a coffee shop. And I'm a personally to this day, I'm a coffee enthusiast and a coffee snob. And I really wanted to take that interest and own a coffee shop. In those days, there was Starbucks, and then there were some large regional coffee shops. But I wouldn't say there was necessarily in the town that I lived in, happened to be St. Louis at the time. There wasn't necessarily a culture of local homegrown coffee shops. And I thought, well, why not try to do that? I didn't have any money. All I had was a great idea. I had a business plan. I'm an accountant, so I had spreadsheets. I had numbers put together. I had some ideas, and I thought, well, I'll just navigate through this path and figure out where the barriers are. And if I hit a barrier that I don't want to try to overcome, I'll just move on and keep doing what I'm doing. But let's see what we can do. So the first thing I did, besides putting these thoughts together, talking to a few family members, putting some Excel spreadsheets together, I started contacting banks. I've always heard that banks are there. Again, this is 20 years ago. I had always heard banks are there to help startups fund their new business. So I contacted several banks, and I said, I'm a borrower, you're a lender. I need money. You have it. Certainly not in those terms, but that was the gist of it. You have it. So why don't you give me money, and that will help me start up my business? I want to rent a location. I have these plans of having multiple locations, but I'll be happy to start with one. I need money to buy equipment. I need money to buy the supplies and start to hiring people. You have money. I need it. Give me a loan. And I physically, audibly got laughed at, because the fact of the matter is, I was an aspiring business owner that wasn't prepared to uh, fund my business in a way that was sustainable, that was attractive to a lender, because of one of the things that I said earlier. I'm a borrower, you're a lender, I need money, you have it, give me the money. And that's what I thought was the reality. And I thought that was the way this worked. And I'm just being vulnerable and transparent with you. It was a lesson learned that that's not the way lending works. That's not the way financing works. If I wanted to start my business, take that huge risk of opening up these stores, buying all of that, and I wanted to do that on with my own money and take that business risk, then I would be perfectly willing or perfectly free to do that. But asking somebody else to fund that and take on that business risk, that's just not how it works. So it was a lesson. If the as I've looked back, the reality is, in the situation that I was in, and that's important to understand what situation you're in. In the situation I was in, I probably needed to start, if I really wanted to do this, I probably needed to start a side business, buy small amounts of product, a small roaster, build a following, go to trade shows, go to farmers markets, build a following that way, and build the business that way. Not try to get to on a spectrum of the alphabet A B C D E F G. Not try to get to MNOP instead of ABC. And that's really what I needed to do, but I didn't do it that way, and I didn't have anybody advising me that that's what needed to happen. So I abandoned all those plans, went about my life, and long story short, I have done other things, and now I look back and I realize if I really wanted to do that, to this day, if I really want to do that, I know a better way through some training, through some different approaches, and that's what I'm here to talk with you about today. I know that directionally a lot of business owners are struggling with this very concept. They may not be at a pre-revenue startup phase trying to get financing, but they may be at some point down the road where they've started their business, but they are trying to grow. They're trying to add new services, add new locations, buy a building, get out of renting, buy in a building, and they're trying to figure out the financing aspect of that in order to help them grow their business. So I talk to people all the time, and I know this is a relevant topic, and hope to give a few nuggets about lessons learned and advice given over the course of time. I've been doing this. Let me just stop here and just introduce myself and say what has changed about me from 21 years ago to now. Spent 25 years in public accounting. Again, hello, my name's Carl Baker, and I own Baker CFO Advisory. And we're doing this series. Thanks for being here. So I spent 25 years in public accounting as an auditor. I have spent the last 8 years doing fractional CFO, business accounting, and consulting services. And I've also, on the side, I have done some lending through various resources, loan brokering, financing consulting. I've gained a newer, greater appreciation for underwriting, which is a very important part of the lending process. Bringing all that together to say that I can help businesses with their financing needs, but I really wanted to just give you some nuggets as you're listening to this. It's more than just going to a bank with your hand out and saying, "Give me money." So that's what we're here to talk about. Hope that makes some sense, and let's dive into it. I do see, as an FYI, that our chat is working today. So if you do have questions, feel free to put any questions, comments in the chat, and you'll see those for those of you who are watching this on a recorded basis later. Again, thank you for your time, and you'll be able to see the notes there as well, and you'll have contact information on the screen and in the notes, and you'll be able to reach out to us if you have questions. Guarantee you we'll get back to you with answers to any questions you might have. All right, so let's move into this. I hope I set the stage with why I'm doing this presentation. I just know it's a relevant topic. So we're going to walk through 5 or 6 stages, starting broadly, working down to a little more narrow perspective. Stage 1: understand the funding landscape. One of the things that I'll say in the outset of this presentation is this is not necessarily a traditional, conventional bank lender ABCs of lending. So I'm not going to sit here and talk about all the things about SBA lending, all the things about commercial mortgage lending, all the things about working capital lending. That could be for another setting. This is going to be a little more broad about what introduction to to those topics, and what you need to do to be aware of your responsibility as you're seeking the financing. So that's really what the perspective is. It's a truth that not all funding is created equal, and it has to do with the way financing is underwritten, and it also has to do with various needs. Some funding in order to get that financing, you're going to need to have some collateral. Some funding that you are seeking, you won't need to have the collateral. And there are different situations that will apply that will make those situations the right solution for your situation. So it's just important to understand going to a bank and saying, "Hey, give me a loan." That question alone is a leading indicator that there may not be a level of sophistication there that needs to be there in order to call it match wits with a lender. So I'll just leave it at that. And I have another comment here that not all businesses are ready for the same funding, and that very much ties into that. It's important to understand, and I've already alluded to this, it's important to understand what capital are you looking for. Again, going to a bank and saying, I need a loan, give me a loan. I've heard of this thing called an SBA loan. I'm sure that's what I need. That's not necessarily the best approach either. Uh, and I've already alluded to a few of these comments, but I think it's important to understand what are your objectives? What is it you're trying to accomplish by seeking this financing? Do you need financing for 30 days? Do you need financing for 6 months? Do you need financing on a long-term basis, meaning 5, 10, 30 years? And all of those things will lead a lender to understand what is the right solution for you. So just understanding that yourself will give you a better will position you for asking more sophisticated questions, steering a lender towards what you need. Just being able to articulate those needs in a very precise and sophisticated way will help you. Clarifying your goals, challenges, and needs before you choose your funding path. Just keep an open mind. I talk in terms all the time about a financing spectrum, and there's a couple different spectrums we could talk about. We could talk about the financing spectrum that you sit on as a borrower, less ready. I'm adding all kinds of gestures off camera. Less ready versus more ready, and there's a understanding where you are in the spectrum of your own readiness, and we'll talk about that later. But also understanding the financing spectrum from a perspective of the needs and solutions that are available for you, short term versus long term, collateralized versus non-collateralized. Terms are very different for a collateralized loan versus a non-collateralized loan. So just understanding that and being aware for that. I'll talk about it later, but I'll introduce the subject of financing positioning, and that's really what all of this is about, is positioning yourself for successful financing. We talked about it in the notes, but I throw it in here early. I think we do have a great series of white papers in our on our website, bakercfoadvisory.com. And the last one that we have is a white paper that elaborates on what we're talking about today. We'll put out some case studies as well, but I do think we have some pretty good materials that will give you some nuggets. I've said it before, I'm well aware people don't sit there and grab a highlighter and pour over every word necessarily, but I hope you do get a few nuggets from those. I think they're pretty great. So what do funders actually look for? This is the closest I'll get to a traditional financing presentation where we talk about underwriting, and that is to introduce the concept of the C's of lending. And various people talk about it in different ways. I've heard the 7 C's, the 4 C's. I try to keep it as simple as possible, but I put 5 C's on here. What are those 5 C's? Cash flow, credit, collateral, capacity of borrower, and character of borrower. And it's important to understand that there's way more to it than those 4 C's, but guaranteed in some fashion, when you go into a lender's office or you contact them in whatever way you do, the underwriting for a financing will be fit inside the parameters of these C's. Some are more heavily weighted for certain types of financings than others. But obviously, if you have as an example, if you have an unsecured loan, collateral is not going to play into the underwriting, and so that's an example of different weightings. But other components of the C's will be weighted more heavily in that situation instead of collateral. So they're not all evenly distributed among the considerations, but certainly it's important to understand that. That's about as close as I'm going to get to some sort of a traditional discussion on financing, because I'm really wanting to talk with you about being ready and what you need to do to just be aware of financings from a broader level. So I think it's important to understand as we move through the rest of these materials, funders don't bet on your vision. They underwrite to the risk, but they don't take your business risk. What did I do when I went to the bank and said, I'm a borrower, you're a lender, I'm a startup, don't have anything done, don't have any money set aside, not really interested in mortgaging my house. But I need your money. What was I really asking the bank to do? I was asking them to take on some lending risk, but I was also asking them to take on my business risk of getting this business started. And the end result to all of that, if my business failed, the end result would be I would shrug, give them the keys, and that would be their problem. Well, that doesn't work. But I didn't understand that at that time. So it's important to understand lenders are not taking your business risk. There is absolutely risk in starting a business. Are you able to build a following? Are you able to manage people? Are you able to put together processes so that things happen in a uniform fashion time after time after time again, so that your customers have a good experience? There is business risk in all of that. The economy, outside forces that are influencing what happens, and your customer base and your supply base. All that is a component of the business risk. Your lender is not going to take that risk on for you. You have to take that on, and they're going to do what they can to separate themselves from that risk. They want to see that systems work, your business model will hold up under pressure, and they want to see that you are ready before getting their capital. Stage number two, drilling down a little bit more. What are some of the financial signals that will build confidence as you navigate through this process? As I say in here, you don't get funded just because you want growth. You get funded because you're ready for growth, and that you have systems in place, you have processes in place. And you need to essentially be ready for that and not wait for the money to come in that will then help you set your plans in place. Lenders aren't going to invest in the potential, they're going to protect against that risk, and they just need to see that you're ready, and that the only thing missing is the working capital, and that there's a good plan in place to pay those monies back. Actually, we talk about that in this line. The strong business model is your first line of defense. Lenders want to see how you'll repay even if things go wrong. And I think that's important. I was talking to somebody about a year ago who has been in business for 25 years. They had one location, they had a big following, they had plans to add new locations, new services, even. And they went to a bank, and the bank said, well, you haven't had updated financial statements in going on a year. You don't have any of your financial reporting in place. There's no way we're going to give you a loan. So now what do you do? And to be honest, I'll just say that business wasn't really ready to put plans and processes in place. They wanted the bank to give them money, and that's really what their plan A was, and they weren't really coachable. I'm just obviously won't talk about who it is, but they weren't really coachable in terms of understanding what they needed to do to shore up some of their processes. And so they aren't able to access capital. And so they may have a thriving business, but they'll be limited in their growth process. Do your financials back up your ask? So your financial statements are your credibility. They are a leading indicator as to how serious you are taking your business. Do you have a good set of books? Do you have good processes? It's a leading indicator as to whether you are trying to have a sophisticated business or whether you're running on the seat of by the seat of your pants. Are you running by managing your bank statements only, or do you have a set of financial statements available both for internal and external use? Messy books sends the message that your business isn't ready for the next level of financing, even if you think it is. And then those financial statements will provide some data to help lenders, external reviewers, whether they are lenders or I've been saying lenders this whole time, but obviously this also plays into investors. If you're seeking investment capital, somebody that wants to take a percentage of ownership of the business, this all still applies. I just keep using the word lenders. But people will draw conclusions from those financial reports, putting together benchmarks, putting together statistics that can be compared against other like kind businesses that are in the similar space that you're in. So all that's important. So it's just important to keep your financial statements ready for distribution at all times. Going down the line, and we don't necessarily talk about the 4 Cs in each one of these slides, but it is a truth. I'm talking primarily to business owners here, owners that are not necessarily rental activities, although all of these things could be applied to people that are in rental activity businesses, developers, people that own apartment complexes, people that own rental properties. All of this could apply and is very relevant to that setting. But I'm primarily talking to business owners, owners that are operating a business with a customer base. There is an active exchange transaction happening where you're providing a good or a service, and they're paying you for that, and more than just housing. uh, there just in the financing world, there is a different view in operating businesses versus rental activities, and won't talk about all that today. But I'm primarily today talking with business owners. It's a reality that cash flow is an important component as a business owner to the ask for financing. Cash flow is, of course, the real test. You might be providing services, and I've had past presentations where we've talked about some of these matters, but you might be providing services but not collecting on those services, which makes it a moot point. Eventually, you have to collect. You have to have a following that is willing to pay, and that cash flow is germane to the topic as you're seeking financing. Not in all financings, but in many financings, a part of the ask will be, especially if we're talking about growth financing, which is primarily what I'm here to talk about today, where you're at level one and you're trying to get to level two, you're seeking financing. There are things that you expect to happen on a trend line basis. Lenders want to understand, what does that trend line look like? Forecasts, pro forma models are how that is projected. So building forecasts that inspire confidence. Confident forecasts aren't guesses, they're grounded in strategy, they're grounded in reality. If, for example, you have a business that is a $1 million business and you say in 1 year we're going to be a $10 million business, God love you. Hope that happens. But why would anybody believe that? What are the assumptions built into that 10 times growth in 12 months? And I'm not saying that's never happened, and no lender is going to say that's never happened. But it's certainly a more rare case. So how would that happen? And what are your assumptions that are built into that aspired set of results? Um, So just the other thing that we talk about in this slide is multiple outcomes. So there is a concept called scenario planning where you have multiple scenarios inside your forecasting. If this happens, best case scenario, this is what our forecast would look like. If worst case scenario happens, what does that look like? If we just continue status quo, what does this look like? Putting all of those together in a multiple set of outcomes and scenarios provides a robust picture for what might happen. All right, so stage three, narrowing down again. We've set some foundational comments about just being ready, understanding what to fix before you apply the right idea. Your aspirations for growth, adding new locations. I referenced a business owner that I talked with recently. They have a right idea. I'm quite sure they have a following. They have demand, but the right idea can still get rejected if the foundation isn't strong enough. And we talked about that with my example. And it's just a reality when you're seeking to do that with other people's money. So, what are some of the things that might hold you back? We've talked about the level of preparedness in your financial reporting, the level of sophistication, accuracy in your financial reporting. So your numbers need to match your reality. And we talked about the example of a set of assumptions where you might go from $1 million to $10 million in 12 months, 10 times growth. Again, good luck. But and we hope that happens. But what is driving that, and what is the reality there? So the other thing is, are there other components to your operations that are important and that are either hidden or unexposed or masked or even unknown risks? And we talk about a few of the examples in here: a reliance on one client. And it certainly depends on your business and what you are providing. But if you are a business with one client, I think a lender very likely may say, come back to us when the service that you're providing for that one client is available, is being provided to 20 clients. One client, a following doesn't necessarily make. And that will be an important part of the story. And just understanding why a lender will look at that, because if that one client, which probably has the right to leave you as a vendor at any given point, if that one client walks out the door, then your business is done until or unless you have other clients. So that's a risk that will be heavily taken into consideration, just as an extreme example to what might be holding you back. Unreported cash. If you're in a business where you are collecting for services or goods provided both in cash and in credit cards or in other means, but you're not necessarily reporting all of that cash on your financial statements, you're going to save lots of taxes. First of all, that's illegal if you're not reporting that cash on your tax returns and collecting money under the table, so to speak. If you're doing that to not report that activity to the IRS for tax purposes, God love you. You will benefit from that on a short-term basis, but it will certainly negatively impair your story and negatively impair your ability to access capital, because your written reported financial statements will not reflect your entire activity. I was talking with somebody a couple years ago that wanted to buy a business, and I was actually representing the buyer, and the seller was telling the buyer, we were looking at their financial statements, and the financial statement activity results weren't that great. And that was driving the sales price of the business down materially. And the buyer and the seller said, but we have lots of cash activity that's not reported. If you buy our business, you'll be the beneficiary of all of that under the table cash activity. Well, Sorry, but we're not going to buy for that hope. So again, illegal. And also, uh, if you are trying to get top dollar, you need to be able to document why you are seeking that top dollar. So, unreported cash is an important aspect to understand. Hidden liabilities, are there debts on the book, debts not on the books that are owed to various people? All those things, again, not to dive into anyone in any particular case, but all of those things will play into your ability to talk to position yourself for the funding that you're seeking. It doesn't necessarily mean you won't get funding. It means that you might not get the funding that you're initially looking for. If you're looking for premium funding, but have these less premium stories, you might access more expensive capital, but not the capital that is more premium. So just understanding that from a financing spectrum perspective. And obviously, we would say if you're seeking to be a growing business, going from level one to grow to level two to level three, cleaning up some of these inconsistencies will just make your business more uh, attractive to funding sources. I see a question there, and we'll come back to that. All right. Wasn't a question, it was a comment. Thank you for your comment concerning your experience as an underwriter. Appreciate that. That also tells me maybe I haven't totally screwed up some of my discussions about underwriting. And I don't think I have, but appreciate the comment there. Be operationally prepared for capital. Growth moves fast. Your team and systems need to keep up. I can't emphasize enough the importance of starting with foundational financial reporting, but also having systems in place so that essentially this is oversimplified, but you're not winging it. You have a process for everything. You have a policy and procedure manual. Your staff members know how you do business. All of those things start with tone at the top. I was talking to a business owner recently who was struggling with keeping staff, putting systems in place. It starts with tone at the top and demanding a way, and we talk in terms of the way we do business. I actually just got off the phone with one of my people I do business with, and it was very clear they had a message for me about what they were delivering to me via the telephone. I didn't need the level of detail they had, but it was very clear they had a script. And this wasn't like a cold calling script. I do business with them, but they were delivering a service to me. And it was very clear that they weren't going to let me off the phone without finishing their script to make sure I had the information I needed and that they could document that I had that information. So they had a way that ownership group taught their staff, this is how we do things, do it this way every time. That structure in place will come out and will just make you more attractive as you're building your business and as you're seeking capital. Strategic timing and long-term readiness. Can't emphasize this enough. Um, can't emphasize the importance of this enough. Capital flows to businesses and owners that have things under control. And are you sending the right signals? I think that really ties into what we were talking about a moment ago with having uniform processes in place. With all of that in mind, the comment that I have under this stage is to ask and seek financing at the right time. Know what it is that you're solving for. Are you solving for an urgent need or a strategic need? And understand that. I actually had somebody a couple years ago call me and say, "Hey, can you help me get some financing? I'm a little short on cash right now, and I need to meet payroll." And I said, "Well, so and so, what are you talking about in terms of timing? Or when is payroll? And what sort of funding do you need?" Payroll's later today. Well, sorry, that's probably not something I'm able to help you with at this juncture. It's 10 in the morning. You need to have payroll by the end of the business. That's solving for an urgency that is going to create problems, and you're going to have a excuse me, you're going to have a hard time accessing capital. That is a situation that I am not able to help with. Most lenders are not able to help with true institutional lenders. But that doesn't mean that any sort of financing is going to take 3 months, but 2 or 3 hour financing. There is actually short term financing available for that sort situation, but it comes at a price in terms of what that financing costs, and it's those are available, but there are ways to prepare for your financing in a way that doesn't happen. Strategic financing, we've really been talking about strategic financing, but funders can tell the difference between a reactive ask and a forward-looking plan. And the more you're able to understand how a lender thinks, the more you're able to match that conversation. And we'll talk a little bit more about that readiness in a moment here. It's a truth that especially decades ago, funders fund on relationships, not strangers. It's a truth that you can get financing as a stranger. There are a lot of there is a lot of technology, algorithms put in place, but it's also a truth that relationships will help that situation just as much today as it did decades ago. Many decades ago, there was a lot of financing that would happen more so on the relationship. There is a lot more structure because of, I'm speaking in terms of bank lending, and that's a good time to say there are lots of financing. There are lots of capital sources out there that are not banks, institutional, non-bank lenders, private lenders, all kinds of access to capital, private equity firms. Uh, but from a bank perspective, compliance matters have risen exponentially, and so the concept of lending on a good gut feeling is not necessarily something that is done as much today as it has been done in the past. Never surprise a lender. By the way, once you get into a lending situation, never surprise a lender. So this slide is really talking about visibility, consistent updates. That applies pre-lending, but also post-lending as well. And we'll just build confidence over time. Get on a lender's radar screen early, ask for capital, and start that conversation before you need the capital. And that's a concept I call financing positioning. There are there are euphemisms out there, sayings out there, cynically, where people were, and it's usually said by people that were denied funding. They may say something such as, "Gee, I need lending, and at the moment where I needed my banker at the most important time in my business life, that's when I didn't qualify for lending. But so and so ABC business, they don't need lending. They have tons of money, but they are able to get capital. So the cynicism is lenders give money or loan money to people that don't need it as much more so than to people that need it, just like I needed it 20 years ago. Well, the reality is truth because of what we're talking about today. That preparedness will open up the doors and provide more access to capital to those who are just having their hand out, so to speak. So there is some truth to that cynicism. All right, moving into some of our last comments, your next step toward funding readiness. So what are some of those things? Here is a phrase that I'm just going to read because I think it's pretty important. If you are not ready for financing yet, that's okay. You have time. You can uh, build your readiness. It's okay to not be readiness, but the goal is to know that and know your situation before a lender does. If you walk into a bank situation like I did 20 years ago, and like several people I've mentioned in my anonymous case studies today, if you walk into a bank and you're think you're ready, but the lender figures out that you're not ready before you do, that's not a good situation. You have a notch against your credibility. I've actually had lenders say to me, if that situation happens, we're likely not going to want to talk to that borrower for a while because their credibility is lost and it's going to take a while to build that credibility back up. So know it before you're ready, be ready. And again, it's okay if you're not ready. Build your readiness before walking into a situation where you're seeking capital. So, with that in mind, asking yourself, I think it's important to ask yourself, where do you stand today? Funding readiness starts with honest visibility. It starts with an honest assessment. It starts with understanding how a lender thinks and understanding where I think I am on the financing spectrum and where the lender thinks I am, and the more alignment there is in that case. What is my readiness in terms of numbers? What is my readiness in terms of my processes and all of that? And again, the answer to all of that is going to be different if you're asking for an SBA loan versus a commercial mortgage loan. The answer to those questions and the satisfaction of those answers, the acceptability of those answers are going to be different for a credit card application versus an SBA loan. So understanding where you are today in terms of what your goals are and in terms of what you qualify for financing, it's a multi-pronged question. I think it's important because of what I have talked about in several of my examples and of what we've talked about. At some point, if this is new to you, again, that's okay. Seek advice, get some help. I thought I was pretty good 20 years ago. I had not been trained, had not had access to training on underwriting to understand how to think like a lender. And 20 years ago, I could have used that mentoring. Now I am the mentor helping people. And there are other people. I'm not saying I'm the only one, of course. But as you're growing, it's a truth that, especially if you're a single owner or a very small ownership group, surround yourself with people that can help you. I am obviously a strategic CFO, a financial leader. We're obviously available. I hope some of this is education that is helpful to you, but get the help you need to help you navigate through that financing process. I think this is important. I've used this, I don't know how many times. You borrow from a position of strength, not weakness. I sought that financing 20 years ago from a position of weakness. You don't borrow from a position of weakness. You borrow from a position of strength. That cynical view that lenders give money to people who don't need it, they don't give money to people who need it the most. Well, that is this concept of a position of strength, not weakness. They're there not to help you with your business risk. They're there to help you grow your business. And the more ready you are, the more access you'll have. I end with just again a refresher, our free guide, and would really love it if you go to that. That might give you some ideas. We do this every 4 weeks, and really appreciate you watching and listening today or in our recording. Next time, I'm going to talk to business owners that are, again, trying to grow, trying to move into that next level. And we're going to talk about some of the processes and some of the things from a process and a business operation standpoint that might be holding you back. And understanding those, articulating those, what sort of processes, what sort of bottleneck are you contributing to? And there might be some nuggets there. So looking forward to that. I'm going to end with a thank you for your time. These materials will be recorded and put on our YouTube page And our website is bakercfoadvisory.com. I am always happy to have a conversation. If you have questions that you didn't want to put on this, um, in this live chat, but you have questions that you want to ask privately, more than happy to have a conversation. No pressure, no salesy conversations. We're just here to try to help people. So thank you very much. I'm going to end with that and say, have a great day. We'll see you next time. Thanks a lot. Bye-bye.